Welcome to It's the Economy. Even as the new government begins budget preparations, the widespread expectation is that capex and infra push will continue to remain a strong pillar of the budget and policy. Rating companies ICRA and Moody's have organized a timely seminar on the state of Indian infrastructure investments and how much investment is needed and possible in areas like renewables, roads, ports, airports, the words that we are likely to hear in the budget. Joining me to give us a summary of their arguments are Girishkumar Kadam, Senior Vice President and Group Head Corporate Ratings at ICRA, Ravichandran, the EV and Chief Ratings Officer at ICRA, Abhishek Tyagi, VP and Senior Credit Officer, Projects and Infrastructure Finance at Moody's. Gentlemen, thank you very much indeed for your time. We have to cover a large ground very quickly. Mr. Ravichandran, first to you. First of all, has the private capex cycle picked up? Has it taken the baton from the government at all?
Yeah, thanks, Latha, for inviting us to your show. On the capex front, so far, as we're aware, Government of India has been driving the capex cycle through good amount of allocations on the roadside and railways and defense, which is crowding in private sector investments. If one looks at the order book position of some of the private sector companies, they are brimming with orders, so to the extent it's good. But moving ahead on the private sector, pure play capex, I believe this will pick up over the medium term, especially in sectors like oil and gas, the metals and mining, airlines and hotels and healthcare and so on and so forth. These are the areas where we are seeing capex. In addition to that, the PLI-driven investments would also be forthcoming in segments like electronics and semiconductors and textiles and solar modules and so on and so forth. Unlike the previous capex cycle, where it was dominated by investments in the thermal power and refining, etc., where they were really capital guzzlers. In the current cycle, we are seeing investments more on the green side, especially green hydrogen, green ammonia, EVs and battery charging, etc., where the nature of the capex is somewhat changing, which are not capital intensive, because of which you don't really feel the impact that private sector capex has been, happening on the ground. But with more such investments happening, which are back-ended, I believe, the cycle will pick up over the short to medium term, especially now with the political stability. The sector will see renewed momentum on the capex front in the medium term.
Can you give a number? When you say capex has picked up, is there some number, say, vis-a-vis pre the COVID?
Yeah, this obviously one thing that we look at is with regard to the capacity utilization at the aggregate level. So that has been hovering around 74-75% level. So still there are many sectors where they are operating at well below their capacity. So demand is something we are slightly concerned, and on that front, perhaps consumption is something needs to be given a renewed momentum. That some incentives perhaps would be required from the budget level. That could make a big difference. Otherwise, today most industries are operating at good capacity.
I get it. Okay, since you spoke about renewable at such length, let me get Abhishek into the conversation. Abhishek, since you're from a rating angle, the problem with power, including renewable, could be the state of the discoms, the inability to pay. At the moment, are you confident of going into renewable sector without this overhang of credit quality?
Thanks, Latha. See, the overhang of state distribution companies have existed for the last 15 years in this sector. Okay, but over the last couple of years, perhaps things have changed for the better. There have been improvement in the payment for the IPP selling part to the discoms. We have had this in the past as well. There were some false starts in the past, which did not last. But so far, over the last 2 years, I think we have seen that the receivable cycles for the companies which we rate, has been shortening. The payments are more timely. Having said that, for this to be sustainable, the tariffs eventually for the distribution companies have to be reflective of their costs. The subsidies from the government should be timely for the distribution companies, and they have been timely over the last 2 years, actually. But that needs to continue, and the key thing, for this to sustain would be the tariffs, that should continue to be a reflection of the cost of the distribution companies.
Okay, I'll come back to you on which aspect, which part of the power segment you're most bullish on. But let me get Girish as well into the conversation. Girish, the government has been seen to be doing, as Ravichandran also said, doing a lot on infra. What are you expecting in FY25 itself in terms of a confirmation of where money will be spent, roads, ports, etc.? Which will be the flag bearers?
Yeah, thanks, Latha. So, in terms of non-power infra push, certainly, we expect, the policy focus to continue to drive very strong investments in the road sector. In fact, the budgetary allocation towards road sector by the ministry has gone up by more than 8 times over the last 10 years to touch about 2.7 lakh crore this year. And with that background, we expect the road execution to move up by around 8% to touch about 13,000 kilometers this year, thanks to very healthy project pipeline which is there for the sector, almost 45,000 kilometer project pipeline, and the fact that there will be a greater focus from the ministry to ensure faster project execution. So that's on the road side. Even on the port side, thanks to policy focus through Maritime India Vision Document 2030, there is a large investment potential. Almost 800 projects worth of 5.5 lakh crore have been identified. In fact, the progress has been a bit slower. About 20-25% of these investment quantum has already been spent, but the potential is quite significant with respect to capacity expansion in ports, port connectivity related projects, and also port modernization related projects. So that's on the port side. There are emerging infrastructures like data centers, where we see that there is a very solid investment pipeline, almost 1.5 to 1.6 lakh crore over the next 4 to 5 years. Thanks to the explosion in the data consumption that we are seeing, rapid digitalization, lots of favorable policy measures towards the data center as an infra. And also at a state level, there are lots of concessions and the policy measures which are getting adopted, and which is why even the data center investment story is looking quite robust. More than that, even on the airport infra side, committed capex is also fairly large, although it is not to that extent what we see in the roads and power, but still about 55 to 60,000 crore of capex, which is a committed, even on the airport infra side, particularly towards greenfield airports in few cities, brownfield expansions of the airport terminals under Airport Authority of India, and so on. So overall, within the non-power infra side, the investment potential is fairly significant, thanks to policy focus, which is being continued.
Okay. You don't think that road construction can slow a bit? After all, we are losing some time in terms of the earlier part of the year, election uncertainty, and then new government yet to take on. You still think that there will be a 5 to 8% jump in road execution kilometers achieved?
Yeah, so we saw a very significant jump in the road execution, particularly last year, almost 20% jump. Thanks to FY24 also being a pre-election environment year, we saw a great jump, which was also seen in a pre-election environment sometime in 2019, 18, 19 as well. But given the fact that the project pipeline is so healthy, Latha, almost 45,000 odd kilometer, and there will be a greater focus towards the completion of the pending projects, which is why we are expecting 5 to 8% jump in the pace of the road execution even this fiscal. In fact, historically, if you see, the pace of road execution has certainly improved. I mean, 10 years back, the pace of the road execution used to be in the range of 10 to 11 kilometers of road execution per day, right, which has already touched to about 33, 34 kilometers per day, although it is still less than the policy target, but a lot of progress and has already been done in terms of improving the pace of the road execution.
Okay, I think that table will run. Your bar chart was available. Yes, there's clearly been an increase in execution. Abhishek, which part of power do you think will see the maximum investments? We also need grid, transmission, distribution, cells, grid cells. Where do you see maximum money going?
Yeah, sure. I think the largest part of the pie for power investments will be still renewable generation capacity. We are expecting about close to 190 to $200 billion need to be spent over the next 7 years to meet the targets which India has set for 2030. And on the grid again, which is integral for the proper integration of the renewable energy, to the demand centers, the investments will be which will be required will be in the tune of 160 to $170 billion over the next 7 years. So these two perhaps will be the largest part of the infrastructure investments on the power side. But having said that, given that India has not added a lot of coal-based capacity over the last 7 to 8 years, and India is going through a very strong demand scenario, especially for power, India would need to add about another 40 to 50 gigs of coal-based capacities over the same period as well. So that will be additional about 40 to $50 billion of investments, which is required to just meet, the baseload demand, which over the next 6 to 7 years.
Got
And
that.
this will still
I'm
imply
sorry,
higher. No problem.
I'm
Yeah,
sorry,
sure.
I'm interrupting because we are running out of time. A final quick question to you, Ravichandran. In your report, I get the sense that you're still worried about high cost of capital. Why would that be? I mean, Indian companies are, delevered a goodish bit. And we are seeing, what I heard in the report, 15% growth in the AUM of insurance and pension companies, which are basically longer-term investors. Would you still worry about the credit quality of infra companies?
No, certainly may not be on the credit quality of the companies. As such, the deleveraging certainly has been a good trend, and because of that, we ourselves have been seeing upgrades outnumbering downgrades over the last couple of years. The concern arises more from the fact that in some of the infra projects where the IRR is fairly low because of the elevated competition during the bidding stage. So generally, you see about 10%, 12% kind of IRR. In such kind of an environment, if there are any nasty surprises during the project execution, then IRR can further go down during the life cycle. So we did require good cushion on the cost of capital front. So currently, given the elevated interest rate environment, that's one of the concern. May not be a big headwind according to me, but in case that were to ease up a bit, it will really give relief to the project developers.
Okay, we'll have to ensure that. We saw that in the 2012-2013 period, infra projects getting delayed for other reasons. I'm sorry we're out of time, but we will keep a close eye on your seminar and get more takeaways on the state of India's infrastructure. Thank you very much for joining us. Wrap up on Bazaar. Chartbusters coming up.